The Federal Reserve Bank, led by their chairman Jerome Powell, have been fighting inflation, and their fight on inflation has hurt the stock market, it's hurt the housing market, and they're causing some people to lose their jobs. These side effects and this pain caused by the Federal Reserve Bank has caused some institutions and some investors to call out the Federal Reserve Bank and say that the Federal Reserve Bank has gone too far and that they need to stop their fight on inflation. And that's despite the fact that inflation is still at multi-decade highs. This is where the whole concept of one person's trash is another person's treasure really applies, because while inflation benefits some and hurts others, the fight on inflation hurts some and it benefits others. The pros and the benefits of the Federal Reserve Bank raising interest rates are, for one, it helps to bring inflation down. Now, while we haven't really seen a massive decrease in inflation yet, generally raising interest rates is one way to bring inflation down, and that's good for regular people because when inflation falls, it makes life more affordable. So regular people want to see inflation fall. Second, when you have higher interest rates, it makes asset prices, stock prices, real estate prices, crypto prices, business prices fall. Now, while that might sound like bad news, if you are a buyer and you want to buy more of these things, you want to buy more real estate or stocks or crypto or whatever, well, when you have higher interest rates, the price of these things generally come down. It doesn't always have to be that way. If you have a super strong and robust economy, you can raise interest rates and not see asset prices fall. But we are built on this cheap debt, this bubble economy, so when you raise interest rates, it causes these asset prices to fall. And third, you see less speculative investments. When it's more expensive to borrow money, people are more cautious with how they use their money. They don't want to just throw it into speculative investments because now you are more careful with how you invest it. And so you see less dumb investments, but you also see more productive investments. On the other side, the cons and the consequences of raising interest rates means that, well, asset prices fall. So now if you already own things like real estate, stocks, crypto, it's not good because now you're seeing the price of your investments fall. It's also not good for the economy because now most businesses have debt. When interest rates go up, well, many times the cost of servicing the debt or getting new debt now becomes more expensive. So it becomes more expensive to operate. And so especially in our economic cycle, when you raise interest rates, it causes more layoffs. It causes more pain to the economy, and it causes more pain to asset prices. The real issue is, I think this article got it backwards. The article talks about how the Federal Reserve Bank is going too far. It's talking about these investors who are saying the Federal Reserve Bank is too aggressive to fight inflation and is hurting asset prices, it's hurting the economy. So the Federal Reserve Bank should stop and let inflation fall by itself, however that happens. And so what they're saying is the Fed is going too deep right now to fight inflation. But I think the article is missing the whole broader picture, because in reality, the Federal Reserve Bank went too far in the first place to create the inflation. If they didn't create all this inflation over the last number of years, then they wouldn't have to be so aggressive to fight it now. Like in 2020 and 2021, the Federal Reserve Bank printed trillions and trillions of dollars. We cut interest rates to the lowest levels ever. And then not only did we cut interest rates to the lowest levels ever, we kept them there for a very long time. Like in 2021, you might remember the Fed said that inflation was transitory. And because inflation was transitory, the Fed had no need to start raising interest rates. The Fed also said that we couldn't get inflation from all the stimulus and all the quantitative easing and all the interest rate cuts that we had in 2020. So then in 2021, they said that inflation was transitory. And then in the end of 2021, when inflation was between 5 and 6%, that was when the Federal Reserve Bank came out and said that inflation is not transitory. It's not going to go away at the end of 2021 like they thought it was going to. And now they said in 2021 that they need to start fighting inflation, but that it wasn't that big of a concern, so they don't need to start fighting it until later on. So in 2021, the Fed admitted, this was around November of 2021, the Fed admitted that they needed to start fighting inflation because it was going to be around for a while. And then they said that they were going to start fighting it later in 2022 because, well, it's not that big of a deal. It's just supply chain issues. Then came the early part of 2022, and again, the Federal Reserve Bank kept pushing it off. We'll start fighting inflation a little bit later. It's not that serious. It's still supply chain issues. And then they started their fight on inflation in the early part of 2022, but they still said it's just supply chain issues. It's not money printing. The inflation will get better. We don't have to be that aggressive. And now here we are today at the end of 2022, And now the Federal Reserve Bank has really changed their tone. Now they're saying that inflation is a real problem, that it's not going to go away by itself, that it's not just supply chain issues. They haven't said that it was all the money printing by the Federal Reserve Bank, although the money printing didn't just start in 2020. The Federal Reserve Bank also started cutting interest rates in 2019 to prop up and stimulate the economy that we already had. But the Federal Reserve Bank now is saying that, well, inflation is the biggest concern, and they're willing to hurt the economy. They're willing to hurt the stock market. They're willing to hurt the real estate market. They're willing to hurt the cryptocurrency market in order to bring inflation down. And this is where people are getting angry. Well, you're hurting my stock prices. You're hurting my real estate prices. You're hurting my crypto prices. You need to stop. You're making it harder for my business to borrow money. The Federal Reserve Bank needs to stop. But someone is going to be hurt. Either we're going to pay the price now to fight inflation, or we're going to pay an even bigger price in the future. Now, we did cover all of this with what's going on with the Federal Reserve Bank and inflation and the economy in Market Briefs, which is my free financial newsletter. Because the best way for you to get your information isn't Market Briefs. The best way is for you to go directly to the source, read the raw data, read the analysis, and make your own opinions. And I'm not talking about reading it from the media sites. I'm talking about reading the actual data. That way you can make your own opinions. But if you're not willing to do that, or if you're not interested in doing that, the second best thing would be for you to join something like Market Briefs, which is my free financial newsletter, where every day my team is breaking down what's happening in this top inflation, global economy, stock market, real estate, and crypto markets into a fun, easy to read, and witty email. You can read it in less than 5 minutes every morning, and I promise you, you are going to love reading Market Briefs. And the best part is it's free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below. So the real issue is that the Fed is going too far to fight inflation. The real issue is that the Fed went too far to create the inflation in the first place. Now the fight is just in proportion to the inflation that we create. And this is where you have to understand this whole idea of if we are in a bubble economy, then this bubble has to pop. And if the bubble has to pop, the correction or crash or downward cycle, whatever you want to call it, is going to be in proportion to the size of the bubble that we created in the first place. The bigger the bubble, the bigger the pop. The bigger the tree, the bigger the crash. And this is where you have to understand that now we're still facing near record high inflation. And if we're facing such high inflation, the Federal Reserve Bank is going to have to continue to stay aggressive to fight inflation. And right now, today, now this can always change in the future, but today, the Federal Reserve Bank says that they are committed to bring inflation down, even if that means it causes an economic crash, even if that means it causes a real estate crash, even if that means it causes a stock market crash. Now, will they stay true to their word? I don't know. But this is what they're saying today, that they're willing to do this to bring inflation down no matter what. And this is where you have to understand that inflation has a long way to go, which means that the Federal Reserve Bank, if they stay true to their word and they continue to raise interest rates, well, that's going to make it more expensive for businesses to borrow money. It's going to make it more expensive for people to borrow money. This hurts businesses, it hurts stocks, it hurts real estate, it hurts crypto, but it also hurts the government. Because now the government has $31 trillion worth of national debt that they also have to pay interest on. And now, as mortgage rates, as interest rates keep rising, the government is also going to have to pay more dollars to service their debt. Think of it like you spent the last 2 years racking up credit card debt. You've been going to the Gucci store, the Lululemon store, you've been going to Louis Vuitton, you've been buying the double guac on your Amex or your Discover or your Visa, and now you got this massive credit card bill and you're able to pay the monthly payments. But now you're seeing interest rates go up, which means that the interest rate on your credit card is also rising, which means that the minimum payments on your credit card are also rising. So every single month, the amount of money that you have to pay on your minimum payments to service your credit card debt is also rising, not because the amount of debt that you have is rising, although in the government's case, the debt is still rising every single day. So let's assume for the credit card example that you're still swiping money on your credit card every single day. But on top of that, the amount of money you have to pay for your debt, even if you didn't grow your credit card debt balance, the amount of money that you'd have to pay to service your debt is also growing every single day because interest rates are going up. All these things are going to have a consequence. And the reason why the Federal Reserve Bank is saying that they want to deal with it now instead of dealing with it later is because if you don't fight inflation, that's going to have its own consequences. Now you deal with things like a currency crisis, the dollar losing value. You deal with issues of the United States economy now really being challenged because people challenge the dollar. And if that happens, that's much worse than a recession. Now we're talking about a whole potential economic systemic collapse. And that's what the Federal Reserve Bank is working to avoid. And that's where, yeah, we might have to deal with a painful recession. But a painful recession is not as bad as a full-out economic collapse. The question really isn't, are we going to see a recession or not? The question is, when will it be if we're not in it already, and how bad will it be? And this question is going to hinge on the Federal Reserve Bank and what they do. I know I say this a lot, but you really have to pay attention to what they do, because if they continue to raise interest rates, it's going to cause more pain to the economy and asset prices. And if they don't do this, then they're going to kick the can down the road. Maybe they can stimulate the economy, but inflation will continue to get worse. And this is where the question is, what is going to break first? The economy or inflation? And this is a teeter-totter where the Federal Reserve Bank has been, up until this point, trying to walk this tightrope, where they have inflation on one hand and they have the economic growth on the other hand, and they're trying to balance it. They're trying to bring inflation down slowly while not triggering an economic crash. But now they've been working and working and working to try to bring inflation down, and they've made a little teeny bit of progress. But the economy is really starting to slow down. We're seeing the stock market really get hurt. We're seeing real estate prices really get hurt. And this is where now the Federal Reserve Bank is saying, well, we're going to have to get even more aggressive and stay aggressive to bring inflation down, even if that means hurting the economy, hurting stocks, hurting real estate, and hurting crypto even more. But this can also create opportunities now, because I know this might all sound like bad news, but it creates opportunities for the financially educated, for people who are prepared, because if you're financially educated and if you're prepared, it creates opportunity now for you to go out and buy distressed assets at a discounted price. Find the good investments, wait for them to go on sale, and then buy them at a discounted price. If everything goes wrong in the United States, all the companies go down, all the companies start cutting their dividends, all stock prices go down, well, at least now I have some companies outside of the United States that will hopefully continue to be paying their dividends, because now they might not be as affected in their economy as the United States is,